If you were born before 1966, there are 5 Social Security changes happening right now in 2026 that the government is not sending you a letter about. 5 changes. And at least 2 of them could put real money back in your pocket this year, if you know they exist and if you actually claim them. But before I go any further, I need to stop the 2 most common reasons people click away from a video like this and lose money because of it. The first group hears Social Security changes and assumes this is only for people who are barely getting by. So if they have a pension, some savings, a home that is paid off, they tune out. The second group is on a fixed income, living mostly on their monthly check, and they assume the good stuff is always for someone else, always for the people with more. Both of those assumptions are wrong, and I am going to prove it to you on every single point in this video. Some of these changes help the lower income retiree the most. Others are specifically designed for the person who has built up something over their lifetime. I will tell you exactly which group each one helps and how, so nobody watching can say this does not apply to me. My name is Carter Hale. I am an enrolled agent, which means I am federally licensed to represent taxpayers directly in front of the Internal Revenue Service. I have spent 15 years sitting across the table from the IRS on behalf of real retirees, and the pattern I see more than any other is not fraud. It is not carelessness. It is honest, hardworking people in their 60s and 70s leaving money on the table simply because no one told them the rules had changed. That is the most expensive kind of mistake there is, because there is no notice. There is no penalty that tells you something went wrong. There is just money that quietly never shows up, year after year, that was always yours. So let us fix that right now. Change number 1, the senior bonus deduction and what it does to your Social Security tax bill. I want to start here because this is the single most valuable change in this entire video, and the majority of seniors who qualify for it have no idea it exists. In July of 2025, a new law was signed called the One Big Beautiful Bill Act. Buried inside that law is something called the senior bonus deduction. Starting with the 2025 tax year, which is the return you file in early 2026, every single person who is 65 or older gets an additional deduction of up to $6,000. If you are married and both of you are 65 or older, that is $12,000. And here's the part that makes it powerful. That $6,000 stacks on top of everything you already have. It sits on top of your regular standard deduction. It sits on top of the extra standard deduction seniors have always received for being over 65. You do not have to itemize to get it. You do not have to give anything up. It is simply added on. Now let me tell you who this helps, because it is both groups. If you are a lower income senior living mostly on Social Security, stacking these deductions very likely pushes your federal income tax to 0. It may mean you owe nothing. It may mean you do not even need to file. If you are a more comfortable retiree, you are not left out either. This deduction is available in full to single seniors with income up to $75,000 and to married couples up to $150,000. It only begins to shrink above those numbers. The only people this truly leaves out are the genuinely wealthy. Everyone from the retiree on a modest fixed income to the couple bringing in $90,000 a year gets real money here. One more thing you must know, because it makes this urgent. This deduction is temporary. As the law stands today, the senior bonus deduction exists for 2025, 2026, 2027, and 2028 only. 4 years, unless Congress extends it. So this is a claim it now, every single year while it exists situation. If you use tax software, it will ask your age and apply it automatically. If someone prepares your return, you make sure they applied it. That is change number 1. Do not pay federal income tax you do not owe. Change number 2. The full retirement age just moved, and millions of people born before 1966 do not know what that actually means for their check. Here is the change. For anyone born in 1960 or later, the full retirement age, the age at which you collect 100% of your earned Social Security benefit, is now 67. Not 66. Not 66 in a few months. 67. This is the final step in a gradual increase that Congress set in motion back in 1983. It has been moving in 2-month increments for years, and most people tuned it out because the change always felt like it was happening to someone else, someone a little younger. In 2026, the phase-in is complete. The line is now fixed at 67 for everyone born in 1960 or later. Now, I know what you are thinking. You might be 63, 64, or 65 right now and already receiving benefits. This does not take anything away from you if you have already claimed. But if you have not claimed yet, or if you have a spouse who has not claimed yet, this changes the math significantly. Here is why it matters for people born before 1966 specifically. If you were born between 1955 and 1959, your full retirement age lands between 66 and 2 months, and 66 in 10 months. You are in the transition zone. And the mistake I see constantly is people assuming their number is 66 when it is actually 66 in 8 months or 66 in 10 months. That gap costs you a permanent reduction in your monthly check for the rest of your life. If you claim at 62, your benefit is cut by roughly 30% permanently. That reduction does not go away at 67. It does not reset. It stays with you for as long as you live and for your surviving spouse after you. On the other side, every year you delay past your full retirement age, up to age 70, your benefit grows by 8% per year. That is guaranteed. There is no investment in the world that gives you a guaranteed 8% annually with zero risk. The action item here is simple. Log into ssa.gov, create or access your My Social Security account, and look up your exact full retirement age based on your birth year. Do not guess, do not assume, look it up. The difference between claiming at the wrong time and the right time can be hundreds of dollars a month for decades. Change number 3. The Social Security Fairness Act and the money that may still be sitting unclaimed with your name on it. This one is for a specific group, but if you are in that group, the amount of money involved is significant. On January 5, 2025, President Biden signed the Social Security Fairness Act into law. That law did one thing. It eliminated 2 federal provisions called the Windfall Elimination Provision and the Government Pension Offset. Both of those provisions had reduced or completely eliminated Social Security benefits for millions of Americans who worked in jobs not covered by Social Security and also worked in jobs that were covered. Who does this affect? Teachers, firefighters, police officers, state and local government employees, nurses who worked for government hospitals, anyone who spent part of their career in a public sector job with a pension and also paid into Social Security through other work. If that describes you, or if that describes your spouse, or if you are a surviving spouse of someone who worked in public service, your Social Security benefit may have been quietly reduced for years under rules that no longer exist. The law is retroactive to January 2024. That means the Social Security Administration owes back payments to eligible retirees covering the increase they should have been receiving since January of last year. As of early 2026, the SSA has paid $17 billion in retroactive payments to 3.1 million beneficiaries. But not everyone has been made whole yet. I had a client, a retired school teacher from outside of Columbus, Ohio. Her name is Diane. She taught 3rd grade for 31 years. She also worked part-time jobs throughout her life, waiting tables in the summers, working retail during the holidays, all of it covered by Social Security. When she claimed her benefit, the Windfall Elimination Provision cut her monthly check. She accepted it because she was told that was the rule. She never questioned it. She received that reduced amount for 9 years. After the Fairness Act passed, her benefit was recalculated. She received a lump sum back payment, and her monthly check went up. Not a small amount. For many affected retirees, the average WEP reduction that is now restored is close to $500 a month. Over 9 years, that is money Diane never got back. But going forward, she gets every dollar she earned. If you worked in public service and you have not checked whether your benefit has been adjusted, do not wait. Log into your My Social Security account at ssa.gov and compare your current benefit to what you were receiving before early 2025. If the number has not moved, call the Social Security Administration directly at 1-800-772-1213. Retroactive payments have not reached everyone. Spousal and survivor claims in particular are still being processed. Do not assume someone handled it. Check for yourself. Change number 4. The COLA increase and the tax trap hiding inside it. In 2026, Social Security benefits went up by 2.8% as the annual cost of living adjustment. For the average single retiree, that is roughly $56 more per month. For a couple, more than $100 per month. On the surface, that sounds like good news. And it is. But there is a trap hiding inside every COLA increase, and almost no one talks about it because the people who should tell you about it are the same people who benefit from you not knowing. Here is how the trap works. Whether your Social Security is taxed depends on something called your combined income. That is your adjusted gross income, plus any non-taxable interest, plus 50% of your Social Security benefits. There is a lower line and an upper line. If you are single and your combined income comes in under $25,000, 0% of your Social Security is taxable. If you are married and that number is under $32,000, same thing, none of it is taxed. But as your income climbs, Up to 85% of your Social Security can become taxable. Now here's the problem with COLA increases. Every time your benefit goes up, your combined income goes up. And if you are already close to one of those thresholds, a $56 monthly increase can push you over the line, and suddenly a portion of your Social Security that was tax-free last year is taxable this year. Your benefit went up $56 a month. Your tax bill went up more than that. The win for lower-income seniors is that the new senior bonus deduction we covered in change number 1 specifically pushes many people back below the taxable threshold. That deduction was designed partly to offset exactly this problem. The win for more comfortable retirees is a strategy called income smoothing. If you have a traditional IRA or a 401k, the timing of your withdrawals in retirement has a direct impact on how much of your Social Security is taxed. Pulling a large distribution in 1 year can spike your combined income and trigger taxation on benefits that would otherwise be free. Spreading those withdrawals strategically across multiple years, or in some cases converting portions to a Roth IRA during lower income years before larger required distributions kick in, can keep you below the threshold permanently. This is not something your bank tells you about. It is not something the Social Security Administration mentions when you sign up. It is the kind of planning that the people I work with wish someone had explained 10 years earlier. Change number 5. The one thing happening right now that seniors born before 1966 need to act on before the end of this year. This last one is not a law change, it is a deadline. And it is the one that costs people the most money because it passes quietly and there is no second chance once it is gone. If you turn 65 this year, or if you will turn 65 before December 31st, there is a Medicare enrollment window that is open right now and will not stay open. Missing this window means paying a permanent late enrollment penalty on your Medicare Part B premiums for the rest of your life. Not a one-time fee, a permanent surcharge added to every single monthly premium forever. The penalty is 10% for every 12-month period you were eligible but did not enroll. If you miss the window by 2 years, your premiums go up 20% permanently. If you miss it by 5 years, 50% permanently. Most people assume Medicare enrollment is automatic. It is not, unless you are already receiving Social Security benefits. If you have not yet claimed Social Security and you are turning 65, you have to actively enroll in Medicare. You have a 7-month window, 3 months before your birthday month itself, and 3 months after. But here's where it gets more complicated for people who are still working or still on an employer plan. If you have coverage through an employer with 20 or more employees, you may be able to delay Medicare without penalty. But the rules around what counts as qualifying coverage and what paperwork you need when you eventually do enroll to prove that coverage existed are specific. Getting it wrong, or assuming your HR department handled it, has cost retirees I have worked with thousands of dollars in penalties that never go away. One more piece of this that almost nobody mentions. There is an IRMAA surcharge, the income-related monthly adjustment amount, that gets added to your Part B and Part D premiums if your income crosses certain levels. And here is the trap inside that trap. The income they use to calculate your surcharge is not this year's income. It is your tax return from 2 years ago. So if you retired recently, or if your income dropped significantly due to any life event, you may be paying a Medicare surcharge based on income you no longer have. There is a form to fix it. It is called the SSA 44. When you have had what the government calls a life-changing event and retirement is specifically on that list, you file that form, you show them your income has fallen, and they recalculate your premium based on your actual current situation. I have seen that single form put more than $2,000 a year back in a retiree's pocket. Almost nobody files it because almost nobody knows it exists. Let me tie everything together with the one idea that matters more than any single rule I just gave you. Every change I just covered is already in effect. The senior bonus deduction is in the law. The full retirement age shift is final. The Social Security Fairness Act payments are being processed right now. The COLA trap is happening to people's tax bills this filing season. The Medicare penalty window is open for people turning 65 this year, and it will close. None of these are automatic. The government does not refund you for a rule you did not claim. Nobody mails you a check for the deduction you forgot to take. Nobody calls to tell you that your benefit was miscalculated for years under a provision that no longer exists. Nobody warns you that the Medicare window is closing. The entire system is built so the money stays where it is, unless you stand up and claim it. Being legally entitled to something is worthless until you act on it. I put together a free checklist that walks through every point we covered today, including the exact steps to check your Social Security Fairness Act payment status, the SSA 44 form for Medicare surcharge appeals, and the full breakdown of the senior bonus deduction. It is called the 2026 Senior Benefits Checklist, and you can get it completely free at carterhaletax.com/checklist. The link is also right there in the description below this video. Print it out, go through it before you file this year. For almost everyone watching, it is worth far more than the 2 minutes it takes to grab it. Let me leave you with this. The people who miss out on every single one of these changes are not careless people. They are not people who did not work hard. They are people who assumed the relief was for someone else. The lower income retiree assumes the good stuff is only for people with money. The comfortable retiree assumes the benefits are only for people who are struggling. And so both of them keep losing money that was always theirs. You now know 5 changes. You know what to claim, what form to file, and what deadline is sitting in front of you right now. Do one more thing for me. Send this video to one person in your life who is over 65 or getting close. It does not matter whether they are living on a single check or sitting on a paid-off home and a healthy IRA. The odds are very good that at least one of these changes is affecting their money right now, and they have no idea. That is what this channel is here for. I will see you in the next one.